Hey, thank you, Jeanette, and thank you to the Foresight team. Catriona, is it what a kind of a shock to hear that you're moving on. So we hopefully can celebrate at some point to acknowledge all of the great work that you've done there. Good morning, everybody. It's December 4th, 2020. I'm very delighted to be moderating this panel on the circular bioeconomy. We have distinguished panelists to speak with today, and they're all very sophisticated investors operating in clean tech, which of course includes the circular bioeconomy. I will ask the panelists to introduce themselves and define this circular bioeconomy in their own terms. And just as background, at Fort Capital, we are a boutique investment bank with offices in Vancouver and Calgary and Toronto. And I'm personally focused in the clean tech space along with a couple of my partners. And so it's a great pleasure to be talking to you and with these panelists today about the investment continuum across the different stages of investing. And each of these panelists represent those stages beginning in the early seed stage, and then to the growth stage, and then finally to the deployment and full commercialization stage. So our panelists today are Danielle Joseph, Executive Director with the Closed Loop Ventures, the seed and pre-seed fund within Closed Loop Partners, and she's based in New York City. Kookai Chaimahawong, an associate with Pangaea Ventures, based here in Vancouver, and Graeme Millen, Director of Technology Banking at Silicon Valley Bank, Canada, and is based in Toronto. So as I mentioned, these three investors are active in the three different stages as these companies involved in the circular bioeconomy progress. And if you're an entrepreneur out there, this is sort of what success looks like. These are the type of organizations that you'll be meeting along your journey to success. And so, as I mentioned, I think it would be great if we started with the panelists to define in their terms, what is the circular bioeconomy and how is that expressed in your investment thesis? So let's start at the beginning, at the early stage, and then seed stage. Danielle Joseph is Executive Director of a very appropriately named fund for this circular economy topic, Closed Loop Ventures. Danielle, over to you. How do you define the circular economy and how is it expressed in your investment thesis?
Thanks so much, Paul. Yeah, and so it's great to be here with everyone today. When we think about circular economy, specifically circular bioeconomy, as this is aptly titled, we think about biology actually as the epitome of a circular economy, where every type of waste output that is produced in a biological system actually becomes an input for a new biological process. And that's the epitome of a circular economy. When we talk about it as Closed Loop Partners, which is an investment firm and advisory services business exclusively dedicated to the circular economy, we invest across different asset classes, everything from venture, growth equity, private equity, debt capital, as well as working with a number of major corporates to make their operations more circular, but also to invest in necessary infrastructure to create these circular systems. We think about it both from a biological perspective, but also from a just traditional material perspective. There are lots of materials that we're putting into our environment today that are not biologically based, whether that's plastics or metals or cement or other types of materials that we use in day-to-day life. And so when we think about circular economy and investing in it, we think about it across those categories. As a fund specifically within Closed Loop Ventures, we focus on 4 key sectors: plastics and packaging as one, food and agriculture as another, so that ties in well to our the organics thesis. We look at textiles, fashion, and apparel, as well as supply chain optimization technologies, a lot of transparency solutions that we see as necessary enablers of understanding where material is flowing today and how we can move it into the highest and best use case in the system. We can talk more about what some of those examples are, but I'll leave it there and let the next person introduce themselves.
And Danielle, I'm going to ask all the investors here, if you could just sort of summarize for the listeners your size of fund. What is the typical ticket size that you invest in, initially and for follow-on, and any important conditions that you might have for investing, taking a board seat, et cetera.
Sure. So Closed Loop Partners, again, we have multiple different investment vehicles at a high level. Closed Loop Ventures is looking at seed and pre-seed stage deals. So typically that's, maybe you're just starting to generate revenues from having a product in market, or just before that stage, but you're close. We typically invest $250 up to $1 million in a first round, and then reserve additional capital for follow-on. That detail is all on our website, as well as the detail for the other funds, which scale up along with the kind of scale and stage of the companies that they're investing in.
Okay, great. And so plastics, ag, fashion, and supply chain really is a broad sampling of the economy there. I'd love to come back to the fashion. I don't know if that's fast fashion that you're dealing with, but it's an interesting topic here in the circular bioeconomy. So let's move on to the next stage in the growth stage for ventures. And we have Kookai, Chaimahawong from Pangaea Ventures here in Vancouver. So Kookai, in your world, can you please explain how the circular bioeconomy overlaps with Pangaea and some examples of our portfolio?
Yeah, of course. Thanks, Paul. So Pangaea Ventures, we're a North American-based fund and based in Vancouver in Canada that invests exclusively in advanced materials innovations or science-based hard tech. We invest in companies solving, fundamental global challenges. So 3 buckets here are our thesis: climate change, food and water security, and health outcomes. Our funds are backed by 25 strategic corporations. So that ranges from consumer brands like Adidas to, chemical companies and oil and gas. So you can see the logos on our website there. And our typical sweet spot is early growth, as Paul mentioned. I was really thrilled to see Danielle as one of the panelists today, because we've actually been in conversation for the past, few years, actually, because we're sort of the, natural follow-on sort of investor. We invest typically $3 to $5 million in companies with early commercial revenue. So, early commercial revenue is typically when the technologies are substantially de-risked and that our capital is used to really inject into that commercialization and growth. So in terms of the circular bioeconomy, we as our thesis, says, we really fund new materials for the future. And being in advanced materials, we invest in companies that produce things. And I think for the past few years, actually, we've seen the shift of companies in the ways that they conceive their materials that make up of their products, and the push for the production models that actually reduce the reliance on raw materials or virgin materials by continuously, cycling materials, all types, back into the supply chain again. So circular economy, bioeconomy, has already been a majority part of our thesis. And I would even go to extent of saying that, it is the evolution of our thesis. We will see more companies that are sourcing materials from, waste stream and, recycling that back again. So circular bioeconomy, as, I like to sort of, attempt to define it. I think I see it in sort of the 3 buckets. So the first one being sourcing, manufacturing, and recycling. So in terms of sourcing, we talk, obviously the theme today is really about waste as an asset, sourcing feedstock and base materials that, do not typically require sort of, land usage or new water usage. And that's, I think, a number of trends that we've been seeing, being raw materials prices are unpredictable, constrained resources. And I think companies, instead of seeing waste as obligation, they're seeing it as the point for value creation. So our latest investment out of the fund is actually in a company called Tidal Vision, which is just across the border from Vancouver here, where they upcycle crustacean waste, so seafood byproducts, into chitosan, which is a non-toxic, biodegradable, biocompatible polymer that can be used in multiple applications like wastewater treatment, textile treatment, or biostimulants in agriculture. So from this sourcing perspective, on the first bucket here, currently there are about 6 to 8 million tons of shellfish waste that are produced, locally, that either go to landfill or being dumped in the ocean. And one of the big investors in Tidal Vision, actually the existing investor before us, is Trident Seafood, which is the largest seafood company in the US. So from this sourcing perspective, you're already seeing that, companies are seeing that their waste, is really an asset and is a point of value creation. On the second bucket, in terms of, bioeconomy here, is manufacturing. I think, Danielle really said it really beautifully around, bioeconomy, biology as a sort of the basis here. So I think, manufacturing things like, with fermentation, industrial biotechnology really plays a key role here in allowing you to convert the waste into end products, whether that's food, fuels, drugs, chemicals, and so on. So one of our portfolio companies, Callista, uses fermentation platform that's similar to making yeast, converting methane into high protein feed ingredients. And the last one is the recycling bucket. So I think this is where you're closing the loop here, where waste products are being used again, from post-consumer waste into the source of materials, and and that kind of is the loop that we're seeing here. And along sort of that we also see what I call, and this is also my definition and my attempt here, enabling technologies, or technologies that kind of support the loops that may not be sourcing sort of waste as the feedstock. We have a company called Hazel Technologies, which has a drop-in solution that extends the shelf life of produce by 4 weeks. So naturally sort of, decreasing and tackling sort of the food waste problem here.
Wow, that's a great examples of the circular bioeconomy, Kookai. Thank you. You mentioned about methane to food ingredient. Is that correct? Can you that a little bit for us on what that is? I mean, we have such an issue with fugitive emissions, as we call them, and such. And does it overlap with that? Where do you get the methane from?
Yeah, so currently the company is sourcing methane from natural gas, but in the future they'll be able to obviously, use that from industrial, emissions and so on. And there's a number of companies actually that are attempting to do this, not just limited to methane. You see also like carbon, sources as well being converted into higher value products. But Callista, really simple sort of definition is really using fermentation. How I like to say this, like the way you create yeast, and actually the products that come out today that are commercializing is feed ingredients. So, aquaculture feed, not food yet. But we also have a number of companies in our portfolio that are using fermentation as a way to produce new food. That may not be sort of in a circular theme, but definitely in bioeconomy theme. We just invested in a company called Prime Roots that basically ferments koji, or mycelium mushroom, and turns that into meat substitute products, so alternative proteins.
Cool. Oh, great. Thank you. So Graeme, on to you. And really, I think we're talking about where firms have really proven their product. They have revenues. We move to the last stage, the deployment and full commercialization. Could you please take us now into that sector of investment, and maybe define the bioeconomy, circular bioeconomy in your view, and how that's expressed in your investment lens?
Totally. And honestly, this panel and the order of operations here is, I think, a testament to the way SEB can participate when you see such great perspectives on investors like Danielle and Kookai and how they sort of support businesses through the process. That really is foundational to part of SEB's thesis. And I'll sort of unpack this in a few different directions, but Silicon Valley Bank, all we do is tech and innovation, very broadly speaking. And we do that by working in very close partnership with strong investors who understand sort of the depth of the technology, the business, and the sectors, and who have the capacity themselves to support the continued growth and success of these businesses. So of course, an organization, a founder who has worked with sort of the likes of Danielle and then Kookai, makes our life very easy. Because they've sort of come through this process. They've had a business which has been well-developed, tech which has been commercialized typically. So I think the way to characterize SUB's participation, again, broadly in tech, and I'll specifically focus on obviously the circular bioeconomy. Again, all we work with companies and founders from idea and a heartbeat all the way up to the Shopify's or maybe the Beyond Meats of the world, a better example today. And we're specifically doing that through the B in our name, which is a bank. We are a bank. I promise we're not like most banks. We're pretty cool. You know, our focus on tech, again, not the corner of our desk, a small group tucked away that does it because it's kind of cool. It's literally all we do. So within that breadth of focus, you know, we're typically providing capital to companies that have kind of raised a Series A. Many of the companies are pre-revenue, but vast majority are not profitable. We're looking to that relationship with the investors to help companies early on, provide additional fuel to pour on the fire for growth, drive extra runway, support working capital needs, and ultimately sort of support these companies at the early stage, again, all the way through their growth cycle. So I think one of the things that SUB's done, and this maybe relates to how the organization thinks about engaging with specific sectors, and again, the circular bioeconomy certainly being one, we have deep sector expertise. And part of this is acknowledging different types of technology, different types of businesses have different capital needs, different types of, you know, strategic relationships that they need. And so whether it be, you know, fintech and e-commerce or robotics, we've got all that too. We also have a dedicated energy and resource innovation practice, which I have the privilege of leading in Canada. And within energy and resource innovation, that's everything from ag tech, food tech, electric vehicles, and a host of other things, oil and gas, water tech. And what that does is it allows us to bring specialized expertise and products, sort of debt and banking products to support businesses at the different stages of their life. So that kind of umbrella and sector focus is really how SUB approaches helping companies here. So I can unpack that a little bit, but the one thing I do want to put a plug in for, because people who know me know that I'm only been in the bank for 2 years, and my background is definitely not banking. I spent about a dozen years of my life developing, investing, building, and operating clean energy projects, much of which has been bioenergy and in clean tech. And specifically in anaerobic digestion, farm, municipal, and industrial-based anaerobic digestion for a long while, worked in the torrefied biocoal sector for a while. So I've touched on the bioeconomy personally as an operator quite a few times. So it is an area that I'm personally quite invested in. I now have the luxury of kind of bringing the breadth of the SUB platform to these organizations. So in the vein of defining it, and I think I got some big shoes to fill after I think Danielle and Kookai did it so eloquently. I'm going to go maybe with a simplistic approach, and part of that is because I think it's broad in terms of, you know, the implications and applications of the sector. So for me, I kind of view it as the efficient use and reuse of natural capital and technology and businesses that can enable that. And I like to define it broadly because I think sometimes these are technologies and businesses which are drawing the entire circle themselves. And again, from my experience on, let's say, you know, farm-based anaerobic digestion, where you have the ability to potentially draw the entire circle yourself, to technologies and companies which are a piece of that and are therefore enabling the broader circular economy. So I think I like to just kind of view it very, very broadly, and then I guess maybe leave it to the experts to get into some of the nuances. But I think for that breadth, both in the context of the technologies and businesses that fall within it, also lends to the breadth of impact and sectors that can be influenced by these businesses.
That's fantastic. It's such a pleasure to speak with a banker that has such operational experience in the sector and brings a kind of, I think, a unique lens to risk and investing in risk to Canada. So congratulations. You're very active in the clean tech space, and a lot of the entrepreneurs have recognized that at Silicon Valley Bank and working with you. So I wanted to ask, you know, there's a lot of potential incubators, accelerators, and government personnel as part of the audience today. As investors, even so, going back to what we call the upstream innovators, maybe even just before they're talking to, the seed investors, what kind of advice would you provide those accelerators and incubators to help their portfolio applicants and companies coming into their early non-dilutive funds? What kind of some of the advice you would give them to build investable companies that you're looking for? Of course, Graeme, they're going to go through quite a number of iterations before they get to you, but maybe this is more for Kookai and Danielle. Can you give it kind of advice on what are investable looking companies? What do they look like when they first come to you? And Kookai, there's a question here about what is the minimum revenue number that you're looking for. So also, if you are interested in asking these questions, please use the chat line, and we, Catriona will help us deliver those questions. So over to you, Kookai, first.
Yeah, so
doesn't matter, one of you. Okay.
Sorry. Yeah, in terms of sort of the minimum revenue, there's really no minimum revenue. We'd just like to see that the technologies are substantially de-risked. So we would consider anything from purchase orders to just, having, wherever you are in that revenue stage. So, no minimum, and really depends on, what markets and applications you're going after. And, obviously the capital intensity that is required to get you there as well. In terms of sort of the advice for universities, accelerators, etc., I would say that in terms of circular bioeconomy or sustainability in general, I always go by the rules of thumb that sustainability should not be a compromise on price, performance, and convenience. I think we see a lot of companies coming out and saying, we are sort of the green alternatives, and that may have worked before, and maybe in sort of the niche sectors being, we're the premium, alternatives and, the eco solution. I think that in terms of scalability and today's sort of world, it doesn't really work anymore. And I think you really have to push forward the functionality and the performance, especially, competing with, conventional solutions today. So instead of really going after, the greener, better alternatives for the world, I think it's really the functionality, performance, and convenience as well being sort of the key things here. We always look for companies that are solving urgent problems with tailwinds behind it. I think with circular economy, we're definitely seeing that, especially around regulatory push, and especially what close to partners have been doing as well in terms of working with, regulators, governments, and, all the ecosystem partners, and really, getting everyone together to support this. So, I would really encourage, companies or, the ecosystem partners to look at the markets that, there's either regulatory challenges, regulatory push, being, the ban of certain, usage of chemicals and so on, or the waste that today it cannot be just disposed in landfill anymore. So that's sort of the two advices here.
I think what Kookai said is largely aligned with us at Closed Loop Partners, which is I think why we can work together so well, which is really great. But I think one thing that I'll underline that Kookai just mentioned is that it's really important to be competitive in the industry with what is traditional out there. You're either winning on price, convenience, and especially in some of if you're replacing a commodity, that's incredibly important. And then performance as well has to be at least on par with the existing technology. I think the other underline I'll mention is that you have to really be serving for a need versus a nice to have. And I think there's a lot of, what we see is that, some entrepreneurs in the space are very well intentioned, but maybe haven't done enough user testing. And I think that's one area where a lot of accelerators and incubators and universities can be incredibly helpful in making those introductions, allowing those entrepreneurs to do in-depth customer interviews with as many potential users as they can to really understand both the need and the use case of their product, who's going to be willing to pay for it. That's a lot of kind of free work that you can do just by interviews and having the right connections to industry players. That's a huge indication of thoughtful business building expertise that then we're more inclined to fund even at those early stages. I think the other part that I'll pull out here is something that Graeme mentioned, which is that there are some companies that solve for a part of a system. There are some companies that solve for an entire circular economy system. It's a lot harder to solve for an entire circular economy system than it is for a part. And there's a lot of value in being incredibly focused on solving for that one piece of the puzzle that you are an expert in. Anaerobic digestion might be the only exception to that, where you really are solving for organic waste on site. One of our portfolio companies is called Home Biogas. It's actually an Israeli company that it does small scale anaerobic digestion, household scale, that solves for it. But a lot of the companies that we see that are trying to, let's say, manage an entire supply chain are ones that we don't necessarily believe in, because the founders are often not as focused as we think they need to be in order to build a successful company. I think that's probably where I'll end it.
I've got to pile on. I have, Paul, if you give me 2 minutes, I got to pile on here because I couldn't agree more with everything you guys just said. And I think that there's something I want to riff on here, which is, I'm sure we've all heard this saying, hope is not a strategy. In the context of what the businesses we're talking about here, relying on moral imperative is not a strategy. Fundamentally, like, it has to be a competitive product. And I think what's really interesting is, again, you look at Impossible Meat and you look at Beyond Meat, what they have done is, we need to create a product which is as good or better, which is as the same cost or cheaper. They're not there necessarily on all those metrics, but it is their foundational strategy. And not only have they been able to attract lots of capital, but they've seen a scale that has not yet been seen before in protein alternatives. So I think that's like a foundational truth. I think the other piece, and this is to the message sort of the earlier, and I think everything we're saying aligns, is there's such an important need to develop a commercialization strategy, not just the technology. And I think one of the challenges is there's often a chasm between deep tech and sort of, grant funding to get the best technology that's perfect in the lab. Haven't talked to customers, haven't done early stage validation, haven't got that commercialization strategy dialed. And I think both in the context of attracting investors, but also in terms of developing a sustainable business, these are fundamental questions that need to be asked early, not just when the technology is ready for market. So I just want to echo everything on that you guys have said.
That's great. Great advice. So in the term bankability, Graeme, you've already said that, Silicon Valley Bank Canada kind of moves further upstream than the competitive traditional banks in Canada. And you look at the investors who are already backing the company to kind of help gauge your level of risk. How do you define bankability in this space? And what are the key, besides the investors, what are some of the key attributes and metrics that you're measuring against before you can get involved?
Yeah, it's a big question. And I'm guessing that historically, the question of being bankable has probably been a source of frustration for a lot of folks in this sector. And there's a lot of reasons for that, which we can unpack. From SAB's perspective, I think one of the things that allows us to participate from a capital, like from a lending perspective earlier, is our relationship with investors. And that doesn't mean that we're looking to investors to guarantee loans or anything like that. It's just, we can rely on the expertise, the capital that they've infused in the business to complement it. So, context is, SAB, we bank 50% of all VC-backed companies in North America. And we also bank almost 3,000 VC funds themselves. So we really have this depth of relationship. So if there's an investor that we have a relationship with that's invested in a deal, it allows us to do things that other banks can't. So the reason I say that is that obviously our definition of bankability of a business is augmented when we have the opportunity to look to these partnerships. That being said, I want to reaffirm the fact that for us, we're typically not banking companies that are still in the lab experiment stage. This commercialization, this notion of commercialization is so important. And what the lens that we're looking for is, how is this company building enterprise value? And we are literally underwriting to their ability to drive enterprise value. Some of that is developing IP, but absolutely it's with a view to how does this create commercial value either for themselves in a sustainable business model or through partnerships and future acquisitions. So I think that that ethos of know how to articulate how you're creating enterprise value near and long term is just so fundamental. for the purposes that we're talking about this cool stuff, I will also say we do all that usual kind of working capital, lines of credit. That's just not as much fun to talk about. But I do just think like that ethos of enterprise value building is such an important lens to think about.
Yeah, and I also just want to add on to that, which is, you know, you ask about bankability. There are so many different products that Silicon Valley Bank offers. There's VC funding, there's project finance. It's also really important as an entrepreneur that you've put some thought into what type of capital your business actually needs. And VC is often the default in 2020, but it doesn't need to be, and it hasn't always been, and it will not always be in the future. And so I think it's also worth thinking about, you know, when you think about, are you investment grade or are you bankable? Like, what type of capital do you actually want and need for your business to grow and scale? And then how do you build your business to that need?
Totally agree.
Or how do you find the financing to build the business that you want to build?
And it's understanding what risk are you financing? Some risk is VC risk, some risk is bank risk, some risk is grant risk. And I think understanding what capital matches with the needs is also an alignment with the different risk profile.
Yeah, we always say venture capital dollars are expensive. And so, you know, if you're going to be investing into building the infrastructure and so on, we always refer companies to Silicon Valley Bank. And chances are, you know, you're going to have different blends of financing in order to scale, you know, and so that's definitely spot on.
The only piece that you touched on quickly, Danielle and Kookai, thank you. All the referrals are always welcome. But I'll say that you mentioned project finance. And I think in the world that we're talking about right now, infrastructure, sort of physical steel and concrete in the ground, is more common. My previous to SUB, so SUB, we do project finance, historically focused on what I love to say is traditional industries like solar and energy storage, which is just awesome, but increasingly exploring ways to bring that structure into more creative models, which I do think is still a huge gap, but a huge opportunity from a financing perspective. My background previously was very much in project finance. And what I've come across is those folks who are interested in the notion of project finance as a structure, a scalable structure to finance infrastructure heavy businesses. They've got the tech down, they've got the conceptual business, but there's a degree of commercialization sophistication that is often not there. That your agreements to get project finance have to be of a degree of sophistication and legal breadth that is typically not expected. So I do think that in the vein of, again, guidance to sort of earlier mentors is, if that's on the path for scaling, think about the degree and the sophistication of the agreements that are required to receive really more structured financing.
Yeah, and just to dig into that a little bit, and Graeme, maybe we have similar backgrounds. I also come out of that world a little bit. But you know, very simply, something like a long-term agreement where you have a set price for your feedstock and a set price for your offtake will significantly lower the cost of your capital. And if you're talking about building a recycling facility for electronics or some kind of project that is going to take in waste feedstock X and create, Y product, that's maybe not going to be a venture capital backed kind of business model. And so think about how you can bring in and negotiate those kind of long-term contracts and then take in cheaper financing in order to build your facilities.
That's a great sort of topic about the capital light versus capital intensive industry. In the circular bioeconomy, the prevalence would be sort of, I think, expensive processing, et cetera. Are there examples of capital light that the VCs often prefer in sort of investing 2.0 or 3.0, whatever we want to call clean tech this time?
Yeah, for sure. I'll give some, and then Kookai, I'm sure you have some as well. But we've two portfolio companies that I think would be interesting. One is called Mori. This is a silk-based protein coating company that you can coat food products, both prepared and fresh produce, as well as actually other types of goods to extend the shelf life of that produce, of that food, for 2 to 3 times as long. It's a bio-based material. It's an edible, natural coating, and it's a relatively capital light type of model. We've also invested in a company, I'd mentioned fashion earlier, in a company called Alga Life, which is a microalgae based dye and textile fiber company to replace polymer based and other more water intensive like cotton based fibers. And that is also a relatively capital light company in the way that this is all about how you structure your business. You could take a business like that and say, okay, well, we're going to build all of our algae farms and we're going to build all of our factories and we're going to produce all of this material and then we're going to manufacture our clothing, right? And instead what they've done is taken a much smarter approach and said, okay, no, we're going to kind of orchestrate this environment, but we're not going to actually have a lot of the CapEx spend that's required as if we were to build out an entire facility. So I think, Paul, to your point, there are lots of technologies that could justify potentially building large scale facilities and be very capital intensive. There are also business models that you can choose to do and work with, let's say, contract manufacturers or other feedstock providers so that you don't have to expend that capital. And there are reasons for doing one or the other. Maybe you want to keep certain trade secrets to yourself. Maybe you're more comfortable sharing your IP. Maybe you want to retain that customer relationship. So there are lots of reasons for choosing different business models that are much more company specific.
I was just gonna say, I love being in a panel with like really smart people. So all really good points here. I think, being a circular economy company and attempting to be a full circular, company as well, I think the hardest thing is really securing the supply chain. Danielle touched on sort of the feedstock. If you're able to get them, secure the feedstock, offtake agreements, that has a potential for you to become a venture scale company. But if you have to really rely on sourcing the feedstock, some of the companies that we see, especially in recycling types, where you have to sort it, not just source it, it becomes a bit harder. And how you kind of innovate the business models around that as well. Do you want to set up the infrastructure unit right at the source, or do you have to ship things around? Because at the end of the day, the scalability, and the magnitude of that is really different. But in terms of the infrastructure investments, I think we're seeing more companies that are really leveraging existing infrastructure versus coming out and say, hey, I'm going to need to raise $100 million to build this pilot plant in order to get to another $250 million of the full production facilities. There's a couple of different examples here. There's a number of PHA plastic companies that are leveraging anaerobic digesters facilities. In North America, most of the anaerobic digesters, have invested like $150 million in their infrastructure. And so they're able to kind of partner in a way that, whether that's revenue sharing, whatever business models that make sense for your particular case, to just leverage on what they already have versus building new units. Our company, for example, Tidal Vision, that we just invested in, that again upcycle crustacean waste into biopolymer called chitosan. They leverage existing stir tanks from breweries, from other industries to reduce the capex. So I think this is a really good segue again to Graeme, perhaps in terms of coming in with the blends of financing to support this. At the end of the day, I think it's how you invent the business models, and this is also determined around sort of the goals as well, and what types of companies do you want to be.
Okay, great. We're speaking with Danielle Joseph and Kookai Chaimahawong and Graeme Millen that represent the stages of investment for Circular Bioeconomy Ventures. I think Danielle and Kookai, you both have LPs, limited partners, that invest in your fund. And so you're trying to deliver financial results to them and strategic results to them that are so-called strategic corporate investors. And so to all the panelists, are there in the circular bioeconomy that are really catching your imagination, and maybe for some of the people on the line here listening, it might overlap with what they're trying to do? What are some of the trends that you're seeing right now in this space? And is it being driven by the corporates Are they, yesterday we heard these great corporates, Lafarge, Ford, Suzano, talking about their challenges. What are some of the challenges that you're getting from your LPs? You want to start, Danielle?
Yeah, it's a big question, Paul. I mean, I think one thing to note is that we work with a number of major corporates in different capacities. So we work with folks like Unilever and Amazon and Starbucks and Coca-Cola and Nestle across some of our fund portfolio or some of our fund structures, some of the Center for the Circular Economy, but not every corporate is invested in every fund. And so as a venture fund specifically, we actually don't have the mandate to invest for the strategic benefit of those corporates, although we do have very close relationships with them through the Closed Loop Partners ecosystem. So just a bit of a nuance in terms of how we're framing this discussion. The other thing I would say is that the drive towards circular economy and circular bioeconomy is largely driven by consumers, and the brands are paying attention to that demand. And so there's an interest certainly in new packaging alternatives. There's an interest in changing the product formats of many of the products that are going to market. So how do we make those products themselves less wasteful, less, let's say, water intensive? Then there's an interest in making sure that also all of their packaging of the products that they're shipping and the product formats are actually getting into the appropriate recovery stream where possible, whether that's recycling or organics processing. And so I think, like Kookai mentioned earlier, we're looking at material innovation solutions, new material formats, and then also investing in the recovery infrastructure and making sure that there's enough consumer education. And a lot of this work happens not through the venture fund, but through other entities like Closed Loop, the Center for the Circular Economy, but also like folks like the Recycling Partnership, who can educate consumers so that we can create the circular economy in a much more systemic way. And there are lots of different types of financing, types of grant funding, types of research that are necessary in order to create that. And I think one of the most amazing things about Closed Loop and why I was attracted there in the first place is that all of the corporates that we work with recognize that they can't solve this problem alone, that they really need their competitors in a lot of cases to be in the same room and contributing to the same types of solutions in order to really scale the change that we all want to see.
That's fantastic. Any other comments to add to that, panelists, Graeme or Kookai?
Yeah, I think, from our side, we have 25 strategic limited partners, and for us, it's the GP-LP relationship. So they invested in our funds to obviously invest on their behalf. But, along the way, we also share deal flow companies with them as well. They have ended up investing in other companies instead of us. They have ended up becoming customers, partners, and so on. So, I would say, for us, except from Adidas, which is the consumer facing brands, the rest of them are more like chemical companies, industrial scale. And so, I think they're coming from the perspective, less so on, I want to be circular, but coming from the perspective of, there's this sense of urgency that's growing that, there's a threat to the existence of my business. For example, whether the certain chemicals they're producing today is facing regulatory challenges, or certain things that they have been mining before, are being constrained right now in terms of resources. So they're really coming from that sense of urgency. And just for the past 2 or 3 years, and this is probably an insight from our chemical companies, they have been signaling to us, asking if we have seen other companies in this circular type, but they're just exploring at this moment around what circularity really means for them. But at the end of the day, we're solving the same problems. We're solving the problems of not, mining new resources and using what's already exists today. So I think that's from the perspectives that might be slightly, different from, consumer brands or consumer, corporates. And I think, from sort of the trends perspective, and I see Catriona here, meaning that the time is running out. But just from the consumer perspectives, I was just attending this conference yesterday called Brands and Biology, which is a part of SynBioBeta. So a shout out to that. I think they're the largest synthetic biology conference, that's ever out there. And I'm really a big fan of what they do. But the trends that I've actually been seeing is the move towards consumer products applications. So I think, Foresight published this really nice, article that, really the triangle that shows that, it starts from the bottom, there's biofuels and so on. And really now I'm moving towards, really, consumer products applications. We see companies that are actually producing things like, leather that's made from agricultural waste, cleaning products from food waste, straw from algae waste. There are so many things that are just broader than traditionally what bioeconomy, could offer before. So that's definitely what we've been seeing.
Well, Catriona, do you have some questions that you have been moderating from the audience that you can share?
Yes, there are some great questions coming in. We have quite a few on both Huva and on the Q&A as well. So the first one that has got 3 votes, so I'm going to prioritize it first, and it comes from Tyler Whale, is many early stage companies face the chicken and egg challenge. They need to scale manufacturing to get real customers, but they need money to build manufacturing, yet finding financing to build requires cash flow and real customers. How to address this gap and barrier?
I'm going to go first, and foremost, Tyler, I owe you an email, so I'll acknowledge that publicly. Second, the chicken and egg problem is real, and it's not an easy one to solve. So I'm not going to say that there's a snap of the fingers, and I think that I'm gonna paraphrase quickly in broad strokes. You hear a lot of early stage investors say, "There's no capital, no investors will invest in me, lenders, equity, otherwise." And then you've got a lot of lenders and equity investors who are like, "I just can't find good deals." I'm overly paraphrasing, but there's a gap between, and this is the expectation gap. And I think the relevance here is touching on a few of the things we've already covered. Is what do you need to do from a business perspective in order to attract the different types of capital to make that work? And I'm going to overly simplify, but you need to make a manufacturing facility. Okay, do you need to build the whole thing? You need to literally build the walls and the roof, or can you co-opt next to another spot to be more capital efficient? You need to put in some equipment to manufacture. Is it IP rich, unique equipment, or is it off the shelf? Well, if it's off the shelf, you might be able to get standalone equipment financing from someone who's not a VC, not a tech lender, just kind of plain vanilla does equipment financing altogether. And I think at the end of the day is also recognizing what is equity risk and what is debt risk. And again, if the individual manufacturing facility itself needs X amount of money to grow or to sort of be successful, that's not necessarily going to be VC type equity. That might be kind of private equity that's used to commercial real estate, for example. So I think it doesn't give an easy answer, but there are different pools of capital for different needs. Capital efficiency for your first of is always going to be easier, but you are right. There is a gap, broadly speaking, for deploying first of kind infrastructure in Canada and beyond. I mentioned that SUB, so we do project finance, and we are evaluating different business models that will work for us to take that type of structure into first of kind technology deployments. And I think you're seeing other organizations do the same. There's, why am I blanking? Spring Lane is a good example. I'm blanking on the other one who's much bigger, who raised $1 billion earlier this year for some reason. Someone's going to call me on. Thank you, Generation Capital. There are funds and capital that are recognizing this gap and deploying. So I think that in the interim, it's going to be really understanding what you need to get that done and which pieces of capital are going to help you solve that problem.
I think
Graeme, this is
Graeme said that super well, but I would also add, think about what your minimum viable product is. It's a great concept. Use it as much as you possibly can. How do you get something into market to prove that customers actually want your product before you go spending all of the money to build, even if it's, just some equipment financing, make sure that you know what you're building and you know who's buying it.
Mm-hmm. Yeah, and just to add on to that as well, I think this is a perfect panel for that too. I realize and acknowledge completely that there's a gap here, but one thing that I think entrepreneurs don't know is we actually work closely with one another. So, Danielle and I, again, we've been in conversation for the past few years, exchanging deals, passing companies, to each other. When I come across really early stage companies, I always think of closed loop partners, because they come at pre-seed, seed rounds where they take that, more of the technology risk than us, where we are just, really $3 to $5 million US, early commercial revenue. When she sees some companies, she also sent some companies to me as well. And when I see companies that are in need of that infrastructure, debt, financing, I also think of Silicon Valley banks and, many others that are in this ecosystems. I think, we work really closely to one another. So yeah, it's also an ecosystem here that wants to support you as well.
Great.
It sounds like there's kind of a gap at the very early stage and also maybe at the very end at the extremities of this continuum we have here. And in the later stage, Graeme, it's sort of where there's this non-recurring engineering still to be debugged in these big applications, but it's not quite ready for private equity, et cetera. They're not quite ready to take that risk. And so there's still some gaps here, market failures that maybe our respective government could step in and help fill.
Absolutely.
Often investors are trying to understand how to get in touch with the panelists. So maybe you could just sort of share quickly, what's the best way to get in touch with you guys if they want to talk about an opportunity with you?
We have an online application on our website. Please submit anything that you want us to look at through that. Just for context, we see hundreds of companies each quarter. And so it's hard to process that, which is why we ask that you just send a deck over, and we promise we will get back to you. But that is by far and away the best way to reach us.
And how long does it take for you to kind of, take in these hundreds of deals that you're seeing? And the anonymous ones are always the hardest. If you get something from Kookai, obviously it's a trusted source is much better. But how long do you commit to getting back to these potential ventures?
We try to get back to everyone within a week.
Oh, that's great. Fantastic. How about you, Kookai? How should they get in touch with Pangaea?
Yeah, I mean, they can, reach out to me on LinkedIn or even just emails. I think we're pretty responsive in general. So, feel free to just, reach out to us. There's also the website as well. But, I would say that we're also pretty actively in terms of proactively sourcing companies versus just replying to the inbounds. And I think it's because, we also want to be able to, find the companies that are doing things. I typically go to, Foresight, for example, accelerator programs, because it kind of shows that the companies are really active. So aside from just reaching out to us, I think, the other ways to really attract, investors, and other different groups that, might want to partner with you is to just be active. Go on different competition, reverse pitching, or pitching competitions. I think that's a really good ways, when I see companies that are doing that, I always reach out to them if we haven't spoken to them. And for us, you talk about the time frame, but I guess I'll touch on that in terms of closing the deal. For us, we can move as early as 3 weeks. We've closed the deal, during what I call the peak pandemic, which is it's still that, but there was a way back when it was intense lockdown. We did close 2 deals within just less than 3 weeks. So we can move really fast as well if the timing is right. But we like to get to know companies early. So don't be afraid if you're too early for us. You don't have that commercial revenue yet. It's always good to have conversation, anyways.
That's great. Catriona, is there any other messages or questions from the audience that you'd like to share?
I thought there was a very interesting one. It came in from Paul Shorthouse, who I'm sure we all know as well. And his question is, what opportunities for investment attraction does the panel see as it relates to circular bio or bioproduct manufacturing for heavy industry regions that are currently focused on the petrochemical sector? Does anyone
That's an easy one. Yeah. Like we just started a new panel. The easy to answer but hard to implement is lots. There's lots of opportunity. I think there's inertia in what a region is used to doing. I think there's inertia in what sort of a given company is used to doing. And so the hurdle is less the opportunities and identifying. The hurdle is mapping out a path to kind of navigate the change of inertia into a new direction. And I realize that that's sort of wishy-washy and high level, but for all the reasons we're talking about. So if there's an organization that has deep experience with operations in heavy industry, they've got existing infrastructure, they are looking for ways to diversify, their future revenue streams or their growth opportunities. This dovetails perfectly into the earlier discussion of there's lots of tech companies, many of whom are likely attending this session, who would love the opportunity to partner with them and work with them to take advantage of that expertise, to take advantage of that infrastructure, to take advantage of the operational capabilities they may have on site to support sort of an MVP installation. So I don't think that there's a slam dunk, everyone's going to look this way, but I do think that you've got two sides of that equation who are interested in meeting and having those conversations. Connecting them is a harder thing to do. And maybe this circles back to the role that there is for organizations like the Foresights of the world to help facilitate those interactions. So maybe not as specific as an answer as you're hoping for, but I do think that there's a ton of opportunity there, at least to facilitate those conversations.
That's excellent. I think we're sort of at time, Catriona, is that right?
Yeah. So Paul, if you'd like to share some closing remarks, that would be awesome.
Okay, Danielle, Joseph, Kookai, Chaimahawong, and Graeme Millen, thank you very much for your amazing comments today and insights. Very, very interesting. And over to you, Catriona.